Okay, hi. Thank you all for attending. This is my talk on what I'm calling smarter stock selections or data science for investing. I want to be very, very clear on something. This is not a discussion on how to pick the stocks that are going to go up in the next year, the next 5 years, or how to time the market, or how to predict stock prices in the future based on stock price. Nothing like that. Nothing like that at all. This is much, 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 much more about how to value businesses, how to look at a balance sheet, how to look at a revenue statement, cash flow statement, and try to determine for yourself, what is a good company. And publicly traded companies, i.e. stocks, just happen to have really good data. So that's what we're going to go with. What I want to start by saying is that, one, I am not a finance professional. Do not follow me for financial advice. I am not a finance professional. I am not a CPA. My background is in math. It's in figuring out how much executives should or should not get paid. I now also have a background in data science, thanks to this wonderful course and some other things in my life. And scratch note for any future employers out there who might be watching, I also have a background in quantum computing, specifically the mathematics and the technology and industrial concerns as it relates to quantum technology. And all of my investment knowledge, all of it, comes from either books or listening to lectures or conversations with people or reading balance sheets myself, reading proxy statements, losing money on occasion. So that's where all of my investment knowledge comes from. So take everything you're going to hear with a grain of salt. So I'm not a financial advisor. That said, here's some financial advice. So my number one tip for investing is something you guys already know. One, invest in yourself. We've already done it in this course, right? We've really taken the time to learn new skills, which may increase your earnings potential. It'll not only will it protect you from the competition later in life, you actually become the competition when you invest in yourself. And then just some other little things about, good health is worth, who knows what it's worth in the future, right? My next tip for investing is if you're going to work for a large employer that offers a 401k company match, take it. Take the 401k company match. It is free money. If you don't take it, you are leaving money on the table. It's as simple as that. Consider maxing out your contributions. Same for the employee stock purchase plan if they offer one. So those are just some real quick tips for investing. Another one, itemize your spending. You spend more money than you think on non-essentials. So about 5 or 6 years ago, I itemized my entire bank account transactions and realized I was spending way more on restaurants and bars and movies and other non-essential things, way more than like grocery spending and bills. So itemize your spending and you will find money in all sorts of places. And then automate your savings before you ever have a chance to miss it. As soon as your paycheck hits your bank account, send, whatever the number is, send $500 to your savings account, send $1,000 to your savings account. Just do it before you even have a chance to miss the money. Once you've done all those things, if you still have some extra cash, why not invest in a business, right? And when we say invest in a business, there's actually a few things that we could mean by this. One is you could start your own business, right? No risk it, no biscuit. You work for yourself. I am my own boss, right? But it requires lots of time. It requires dedication. You have to really kick your own ass to make sure that this works out. Two, you could buy ownership in a private company. So think of something like, Shark Tank or The Profit with Marcus Lemonis. The idea is that you're buying partial ownership in someone else's business. Now, some of the dangers with that is you actually might be expected to contribute. Like they might say, hey, we need $100,000 to invest in, this new piece of equipment, and we also need your help on deciding the strategy going forward for the company. So in essence, you might be paying in order to work for somebody else. So you have to be very careful when it comes to buying ownership into a private business. Plus, it's not very liquid. It's hard to extract cash on demand. So if you need to put a down payment on a house or something, for example, you can't just go to the bank and say, hey, do you want my 30% interest in Joe's laundromat down the street? There's nothing to do with it. And if you go to Joe, who owns Joe's laundromat, he might not give you the money that you need, or he might give you a bad price, right? So there's some dangers when it comes to investing in private businesses. And then another alternative is to buy ownership in a public business, otherwise known as purchasing stocks or investing in stocks. these fractional ownership shares are highly liquid, right? There's a very large market of buyers and sellers. You can always find a buyer or a seller for some stock. It might not be the price that you want, but you'll always find a buyer or a seller. You will not control the business when it comes to public companies. Most public companies, the largest owner owns something like 10% or less of the company. So it's very rare that someone actually controls an entire public business. You will not, especially, at least, unless one of you is a secret billionaire and just has been hiding the goods this whole time, you will not control the business. And depending on your point of view, investing in stocks either requires very little time or a lot of time. And there is so much conflicting information when it comes to how to think about stocks, how to invest in stocks. And what I kind of want to do is suss through some of that misinformation and give us all some better tools for how to think about public investments, right? And so what are some common stock valuation methods? Well, the one that I recommend the most is the discounted cash flow method. And we'll go into this in a little bit more detail in a few minutes. But the idea here is that you're trying to figure out how much free cash will the business generate into the future, like 5 years, 6 years, 7 years into the future, which is already kind of suspect. And then you're trying to say, well, I know money today is worth more than money tomorrow. So how much do I discount that future earnings that I just projected, right? So it's a theoretically sound way of going about this, but it's really hard to determine the actual parameters that go into a discounted cash flow analysis. Other common methods include what you might call ratios or multiples. You might have heard of the PE ratio or the price to earnings ratio. There's a price to sales ratio, price to book ratio, and there's a million other ratios out there. These are good for getting a quick sense of what's going on with a company, but it's not great for final decisions. There are all sorts of reasons why a company might have a low or a high PE ratio that don't really have anything to do with the underlying business. Things I do not recommend. I do not recommend investing based on what you think an industry is going to do. For example, you hear people talk about, oh, autonomous driving will be very valuable. Yes, of course it will be. We all agree on that, but how valuable is it? Are we talking about $10 billion worth of value, $100 billion, $1 trillion worth of value? Like, what do we mean when we say autonomous driving will be valuable? That's a good platitude, but how do you turn that into me actually putting money down and investing it into a business? And then you could say, well, let me just invest in the entire sector because I know the entire sector as a whole will do well. Well, the problem with that is if you had that thought in the 1930s about US car makers, you would have been absolutely right. The industry has done so well over the last century in cars, but except for Ford and Tesla, every single American automaker has gone bankrupt, every single one. And we're talking about hundreds, literally hundreds of companies have gone bankrupt. So you would have picked the right sector, you would have picked the right industry, and you would have lost all your money, right? So I would not recommend investing based on industry or technology forecasts unless you're really clued into what's going on with the technology or the industry. And then there's this idea of investing based purely on your gut intuition. You might say, hey, I really like Coca-Cola. I bet it'd be great to invest in Coca-Cola, right? And what they're doing is it's the Pavlov association, right? They're ringing the bell inside your head. Hey, I like Coca-Cola. I bet I'd like the investment. Or you might say, I hate Coca-Cola. Let me short the stock. And those are both very bad ways of going about investing decisions. It's not trustworthy, but sometimes you get a gut feeling about a product and you actually investigate the numbers. And hey, it turns out not too bad of an idea. So that was just a caveat I want to include in there. Then one more thing on patterns of behavior. When it comes to buying and selling, the old adage used to be buy low, sell high. That is terrible advice. Buy low and hold it. Just hold it, because when you buy and sell investments, you have to be right twice. You have to be right once when you buy the investment, and then you have to be right again when you sell it. Why not just buy a great business at a pretty good price and hold it while it continues to compound and grow for you? But don't take it from me. Take it from this guy, Phil Fisher, who said, in the earlier times, finding the really great companies and staying with them proved to be far more profitable than the, quote, more colorful practice of trying to buy them cheap and sell them high, right? So this is just buy low, sell high. No, buy and hold, buy and hold, buy and hold. So what did I actually do for my project? Well, I tried to model the market. What I did was I started with a list of 3,600 something publicly traded companies. I pulled financial data from a source called stockrow.com. It gave me income statement information. So that's like revenues, earnings, gross profit, that type of information. I also pulled balance sheet information. So assets, current assets, liabilities, current liabilities, shareholder equity, those sorts of metrics. And also cash flow statements, operating cash flow, capital expenditures, dividends that are paid, so on. And just a quick note for the nerds out there, I wanted to have an Apple data frame, Microsoft data frame, Intel data frame. Turns out Python won't let you create dynamic variables from a list. So instead I used dictionaries to suss all this out. And the data was actually pretty nice. I didn't have to do much type conversions. There wasn't a lot of missing data. It was actually really easy. So I highly recommend using StockRow data for financial analysis. Not every company reports everything. And so for modeling purposes, I extracted the most common financials before, really combining and manipulating the data. And at the end of the day, I ended up with something like 2,900 companies, each having an average history of about 9 years worth of quarterly trailing 12 months data. I had 15 economic features like revenue, earnings, assets, dividends, so on. And ultimately 104,000 rows of data. So, 15 times 100,000, let's call it 1.5 million data points, something like that. So that's what I was using to try to better understand the financials of the public stock markets. And just to get my feet wet, I decided, well, can I use these financials to classify them based on sector? So there are officially 11 GICS sectors, that is global industry classification sectors, for those who are or are not in the know. And so my question is, do company financials naturally align along these sectors? There's a reason that we have these sectors. It's to say, it's plausible that Exxon is very similar to Chevron, but it's not similar to Dr. Pepper or Coca-Cola, right? So sectors, you would hope that they would share certain economic characteristics. In my random forest model, I just did a 50-50 train test split, default parameters. If I included the ticker, it predicted something like 97% of the industry sectors. Without tickers, it still got like 9 out of 10, right? Which is, pretty good. So there's clearly something to this idea of financial data's correlating with sectors in some way. But when I ran the unsupervised model, the KMeans model, and just said, hey, there are 11 sectors, please go ahead and figure out what they are. It doesn't seem to naturally correspond. These cluster labels here, these are dummy cluster labels. We had 72,000 rows labeled as cluster 5, whereas the most industry sector that would have been 20,000 in financials, right? So these don't seem to correspond very well with each other. So we have maybe conflicting information, or maybe just different information. Maybe companies tend to group themselves in other ways besides just the industry sector. Let's see. And just a couple of visuals for visualizing the KMeans clusters. I just thought these are nice because they look kind of like Jackson Pollock paintings. And we're talking about 15-dimensional clusters, so I wouldn't expect any of them to really look too grouped on any two-dimensional chart. But I don't know, I like them. I think they're nice, and I created them and I put them in my slide presentation, so I hope you like them. So moving on to the actual meat of what we're trying to do. How do we value a business? And now we're going to go back to this idea of discounted cash flows, and specifically intrinsic value. So intrinsic value can be stated as determining the present value of the future stream of cash that a financial asset will give you between now and Judgment Day. And what we mean by present value of future stream of cash, that's a way of saying, money today is worth more than money tomorrow. If you came up to me and said, hey, Steven, I'm going to give you $100 today, or you can get $100 a year from now, I'm going to take the $100 today. But if you gave me a choice of, hey, Steven, I'll give you $100 today or $200 a year from now, I'm listening. That's a decision I might want to make. So, money tomorrow is worth something different from money today. So we have to discount that money in the future. And with a discounted cash flow analysis, we're trying to say, what will the business generate in the next year and the year after that and the year after that and the year after that, and then appropriately discount that back to today's values. And this requires a growth estimate. And what do we mean by growth estimate? Are we talking about revenue growth or earnings growth or dividends or assets or debts or whatever? We are not talking about stock price. Super clear, we are not talking about stock price. At no point in this are we talking about stock price. At no point in this will my model bring in stock price. I just want to be super, super duper clear on that. We are trying to intrinsically determine the value of a business, not figure out what everyone else decided that they wanted to pay for it. So let's take a look at Apple's revenues just to try to figure out what we mean by growth. So this is what Apple's revenues have done over the last 10 years. It's grown from $100 billion to $300 billion. And the last 1 year growth looks like this, right? Now, is that indicative of the long-term trend of Apple? I don't really know. I don't have a good, predictions are hard, especially about the future. That's a good old Yogi Berra line. So how about 2 years? Well, what if we took both of these growth rates and we just averaged them together? Well, once we've made that step, it's pretty trivial to just say, well, what about 5 years or 10 years? Why don't we just take all these averages and just smack growth rates and just average them together? That's one way of going about it. Another way we could go about it is something I haven't really seen anyone else do. It might be my own method. I might have borrowed it from someone else, though it's hard to remember at this point. But instead of taking all these long averages, what if we just take the 1 year growth rate over all these time periods and average those together and try to get a sense for what we mean by, quote, the growth rate of Apple over the last 10 years. And so with that, if you have extracted the notebooks that's sent in the Slack, now would be a good time to spin up your Jupyter Lab. So I'm going to do just that. And here we go. So I create a notebook that is a DCF walkthrough. This is basically a copy of the blog post that I had put up previously. But if you're following along, I don't have time to debug right now. So I'm sorry. But there is no coding involved. All you have to do is hit Shift Enter. So I'm just going to import some things. And then this cell will just clean up the data frame and make it look nice. That's all I'm doing there. And then I'm just going to clean up the data frame a little bit more to get the financial columns that I'm interested in and turn them into one big data frame. So just Shift Enter all the way down. Then we're going to calculate growth. Hey, remember that chart? We just looked at that chart in the PowerPoint. This is Apple's revenue over the last year. Well, what is the 1 year growth for Apple? Well, we're going to take the most recent revenue, subtract it from the revenue 4 quarters ago, and then divide it by the revenue 4 quarters ago. That's just a simple percentage difference. Apple's revenues grew 21% over the last year. That's pretty good. Over the last 2 years, so this is just a manipulation of the formula. You can see now we're going from 0 to 8 quarters back, and we're raising it to a power. We don't really need to get into the math, but Apple's revenues have grown 12% over the last 2 years. And we can do this. And then if we want to go to what this looks like, I've just created a list comprehension that just goes through every iteration of the revenue and just keeps going backwards. And so the average revenue, 1 year revenue growth for Apple has been something like 11% over the last decade. And what about other growth rates? So we talked about revenue. What about earnings? What about cash, right? What do those look like? Well, for every column in my Apple data frame, the average revenue growth is 11%, gross profit has grown at 11%, operating income has grown at 9%. So we just have all of these averages for what we might consider the company to be truly growing at. And if I average all of those together, I get something like 7% total growth. But notice shares common is actually slightly negative, and that's actually a good thing. We actually want the shares to go down over time. And so based on my own personal judgment, I'm just comfortable removing the lowest 2 growth rates and the highest 2 growth rates just to get a better sense for removing some of the outliers on either side. And so we could say Apple has grown something like 9.4% over the last decade if we include all of its metrics together. And then we're just going to create a metric called free cash flow. It's just operating cash flow minus CapEx. There are other ways of calculating free cash flow, but this is just a really simple back of the envelope way of doing it. Uh, and then I'm going to calculate my free cash flow growth rate. It's something like 10% over the last 10 years. Very nice, very consistent. And when we run the next cell to discount the cash flows, remember, our most recent free cash flow is 108 billion. We're going to multiply it by, or increase it by this 10% here to get 119 billion. And then we're going to discount it by the treasury rate of 1.63%. You can use other discount rates. I just chose this just to have something to throw into my model. And when we do that, we say, oh, Apple's projected free cash flow for next year is something like 117 billion. So we've done it 1 year out. Let's do it for 10 years out, right? This is truly a discounted cash flow model. We've projected the cash flows over the next 10 years and then added them together to get a figure of $1.7 billion. So Apple will generate a value of $1.7 trillion over the next decade, right? According to this projection. Well, what if we increase it to 15 years instead of 10 years? And let's also increase the discount rate because it's so much further into the future that it's much harder to project. And when we do that, we get a total free cash flow of $2.4 trillion for the next 15 years of Apple. And what does that translate in terms of every share of Apple common stock? So let's take that 2.4 trillion and divide it by the total number of Apple shares, which is this right here, shares common. And when we do that, we get the average free cash flow per share of Apple is $124 and change. My projected value, I should say. And if we actually look at Apple today, $126. Like, that's pretty damn good. I don't care who you are, that is pretty good. We did not look at stock price at any point in this projection. We just used a lot of elbow grease and some reasoning to try and figure out what's going on here. And so for the last part of the presentation, I would like to share this into the Slack channel. There you go. Please visit that link. And you're going to see this. Don't worry about the error messages below. They're not actual, well, they are actual errors, but it's not going to break anything. And if I were to type in, Apple right here into my Streamlit app, hey, look at that. It's the revenue that we saw earlier. That's Apple's revenues over the last 10 years. And we also now have gross profit, operating income, net income. And look how Apple's revenues are driving everything. When Apple's revenues spike, their gross profit spikes, their net income spikes. So Apple, the business, the revenue is driving everything underneath it. Now, let's scroll down a little bit. Look at the balance sheet for Apple. Now, this is kind of a mess. So because we're using the wonderful Bokeh, we can, let's say, remove some of these features here. Let's just look at the total assets and the total liabilities. So that's their total, everything they own, and then all of their debts, all their long-term debts. If you subtract the two, you get the shareholder equity value. So that's just something else you can play with. And then free cash flow. Let's just look at the free cash flow here for Apple. And you can see, again, how revenue drives everything. So this bump in revenue that we saw here and here also show up in the free cash flow here and here. So it's kind of nice to understand how the sales of a business will generate downstream effects in its income statement and balance sheet and cash flow statement. And then just for kicks, I created a DCF model for Apple that, you know how we pick 10 years with a treasury rate, we also pick 15 years with a 5% rate. Well, I don't really know what the best number of years is. I don't really know what the best discount rate is. I don't really know what the best growth rate is. So I just kind of did an iterative model that just ran through all of those, kind of like a grid search, right? And this is a way of creating a pseudo-random Monte Carlo simulation. And so you can see in this free cash flow diagram, so Apple's current market cap is something like 2.1 trillion, which would put it around right here, which maybe it's on the expensive side, or maybe my model is wrong. Who knows? Like I said earlier, discounted cash flows have the problem of tuning to the answer. So do I have the courage of my convictions to say this is right? Or do I have the courage of my convictions to say Apple is overpriced? Or do I need to go back and retrain my model? Who knows? So I just want to show you one more example. Microsoft. Oh, and I don't have to hit caps lock. It's pretty forgiving if you just enter in lowercase tickers for financial companies. So Microsoft, again, we have great growth here, great revenue growth. See this little cutaway right here in
2-minute
the
warning.
this is due to the tax changes that happened in 2017. It was a one-time repatriation tax in exchange for lower taxes later. And Microsoft discounted cash flows are here. And so this is the model that I built that I hope you guys will have a lot of fun playing with. It doesn't quite work for everything. So Johnson & Johnson, let's just pull them up really quickly. You can also see they have this cutaway for the tax, but it breaks my discounted cash flow model. So this is something that I'm still working through right now. And more to come in future iterations. So future ongoing work, fix the models, continue to update, CI/CD, continuous improvement, continuous development. Then at some point, I'm going to compare these to actual stock prices, because at the end of the day, that's what we're trying to do. We're trying to find undervalued companies. I also want to pull this data directly from the SEC, but that is not a trivial task to do it. And then I've already reached out to stockrow.com for collaboration opportunities. I just got a response back today from stockrow.com. They would love to see the analyses that I did. So I'm very happy about that. If Lee is watching, she can see that I am reaching out to other people. And so with that, thank you, General Assembly. You guys this has been exactly the program I was hoping it would be. Thank you to Chuck and Varun and Grant for being wonderful instructors. All of my classmates, you've been absolutely incredible. And to everyone that I spoke with who contributed or shared thoughts in any way, you've been completely invaluable to this project. And with that, that is the end of my presentation. Thoughts, questions?
Wow, great work. I think we have time for maybe one question, if anyone has one.
Yeah, real quick. Great work, by the way, Stephen. That was really interesting. I'm looking forward to pouring through the code in more detail later. Did you, when you were forecasting out like 15 years and you had the amount of common stock, I didn't see any account for possible splits in the future. Like 15 years is a pretty long time to go without a stock splitting. So do you have plans on including that later, or how did you account for that?
If you can figure out a method for predicting when a company is going to split its stock, please let me know.
Well, not when. I mean, yeah, I would be very rich if I could figure that out, but maybe that they would 3 times over the next 15 years at times to be determined.
And usually when that happens, financial sites will go back and redo the common stock in past years to account for the current stock split.
Good to know. Thank you.
One more?
Well,
Stephen,
we have you right at the 30 minutes, unfortunately.
I started at 7:32. 10:32, whatever.
Okay, all right, yeah, one more.
Stephen, when you showed us that, I think it was like 124 and change. Was that the price in 15 years or today? I was just confused. I just want to clarify.
That was the average of my 10-year DCF model and my 15-year DCF model, because I don't know which is right. I don't know which is better. So I just decided, why not just take both of them and combine them together and see what happens. I want to emphasize there is so much uncertainty built into everything here. It is, you were merely born in the darkness. This model was born in the uncertainty, right? It treats uncertainty as a feature rather than a bug. So instead of saying, oh, I'm going to get it wrong, I know I'm going to get it wrong. So let me give you a range of possible values and see which one. That's the idea of a Monte Carlo simulation, right? You don't know what the right answer is going to be. So why not just try it a bunch of different times and see what the consensus tends to be? So that's the idea.
But that was for today, right? The price today.
The 124 is what we calculated without looking at the price at all. And then we compared it to today's actual price, which is $126.
Got it. Cool.
In other words, I predicted Apple without looking at Apple. Thank you.
All right, great work, Stephen.